Well, we've got higher rates, a weaker economy, and interest rates continue to rise. But there's still some good news for home buyers. Hey guys, welcome back to Real Estate Power Moves. My name is James J. And today we're going to talk about the shrinking optimism that buyers are having. Now, I've talked about this in previous videos, but today we're going to talk a little bit more about certain factors that are impacting home buyers. And although I mentioned in the intro that mortgage applications have shrank, pessimism continues with home buyers and their thoughts on purchasing a home today versus waiting. But what I want to really dive into is some of those leading indicators and reasons why buyers are actually waiting, or in some cases, they're taking advantage of what's going on in the market. According to the Mortgage Bankers Association, the U.S. housing market continues to weaken as higher mortgage rates and economic uncertainty both weighed mortgage application volume, meaning these two factors are highly affecting mortgage applications and the reason why mortgage applications have decreased. The Market Composite Index, a measure of market index, fell 3.7% to 260.1 in the week ending August 26. 1 year ago, the index stood at 719.4. So let me state that again. We are now at 260 as far as the market index composite, whereas a year ago we were at 719. Guys, if that's not a huge indicator of where we are today, I don't know what else is. Now, we understand that rising interest rates, rising home prices, although again, we've seen a lot of home price reductions lately. Builders are reducing prices, and we also see home sellers reducing pricing as well. They're shifting. There's a big shift going on right now from sellers over towards the buyers, although we are very much still in a seller's market. So just remember, in a seller's market, all that means is that we've got less than 6 months of inventory in most places around the country. Although inventory levels are definitely rising, we still have probably less than 3 months of inventory remaining. So what that means is if no other homes come on the market within 3 months, every home that's still available would be sold. That's what that number means. This is called the absorption rate. Okay. So 6 to 7 months is a good number. That is what we would consider a healthy real estate market. It's not one way on the seller side or the buyer side. It's about as equal as we can get. That number is 6 to 7 months. Now, we are seeing, again, inventory levels are rising and rising and rising as we head into the fall. This is normal. Real estate is a seasonal thing, although homes are sold every month. We do know that the peak time for selling and buying is usually in the early part of spring all the way through summer and into the early part of fall. And then we start to see a little bit of a slowdown in that fourth quarter. And then the cycle will start right back over again in the first quarter of the following year. We understand that the fluctuations are going to happen, but we're seeing a huge shift right now. And again, buyers have a lot of opportunity coming up in this fourth quarter. So the other thing to keep in mind is that the Fed said they are absolutely willing to bring additional pain to consumers by raising interest rates. So we know within the last week or two, we started to see interest rates creep back up to 6%. The Fed's going to be meeting again here really soon. And unfortunately, I think we're going to see another rate increase, definitely on the federal funds rate, but also I think that's going to definitely impact the mortgage side, where we may see a little bit more pain on the mortgage side. But again, as these rates go up, guys, if you're a buyer and you were maybe sitting around waiting for something good to happen, this is it. Now, remember, the interest rate is not something that you have to stay married to the entire time. Okay. You could refinance, although you do have to qualify for this. This is not being said because people just say, hey, you can refinance. Well, just keep in mind, if you do a refinance, you actually have to qualify, right? It's not an automatic thing. But assuming everything is very similar in 2 years, your job situation is similar, or you got a better job situation, you can refinance. So you're not married to the interest rate. But if you believe, like I believe, that housing prices, although we're seeing tons of reductions, we're seeing builders offer tons of incentives to get buyers to come back. If you believe, like I believe, that home prices in 2024 are going to be higher than they are in 2022, then it still makes sense to own a home, right? And there's no one that can tell me anything different that, hey, I'm going to wait for it to crash. Keep in mind, we still have a shortage of homes. However we got to this point, we still have a shortage of homes. So keep that in mind in your decision making. If you're looking to get a home and sell it in the next 2 years, don't buy. This is not the time for you to buy. Don't buy a home. But a 5.5% or a 6% interest rate, this is not a reason alone to not own a home. I understand it affects your buying power. If you are very close to maybe being able to qualify for $300,000 at a 5% or 5.5% interest rate, now we're looking at a 6% interest rate or higher, and now that's completely changing what you can qualify for. I understand there's a lot of people that are in that situation, but for a lot of people, they're just listening to the news that rates are high, rates are high, rates are high, rates are high, and it's people are pulling back just because of that alone. That is not a reason alone to just say, I'm not going to own, I'm going to continue to rent. Because keep in mind, you're renting, you are paying a mortgage, it's just not yours. You're still paying a mortgage. So just look at it that way. You're paying a mortgage. Whose mortgage do you want to pay? That's the question. The available inventory that we're seeing right now is increasing, and home price is decelerating, both of which could potentially bring some buyers back into the market later this year. So I want to emphasize what the article is saying. It's saying prices are decelerating, not depreciating. Decelerating, not depreciating. There's a very distinct difference between the two. A lot of people are looking at depreciating. It's not depreciating, it's decelerating. What does that mean? All that means is that the values of homes are not appreciating at the level that they were early part of 2022. Okay, so we're not seeing home prices jump through the roof like we were seeing in the first part of the year. We are seeing a slower increase in property value right now. That's where the decelerating comes in, not depreciating. It doesn't mean values of homes are tanking. Okay, it's just the appreciation of the homes are not at the level that they were back in the early part of 2022. And even back to the pandemic, when the pandemic first started, we started to see this price appreciation continue. And then it just got to a level I've never seen in my 18 years of being in this business, the first part of 2022. The appreciation was accelerating massively. Well, now we're seeing a deceleration, meaning they're still increasing for the most part. Values are still going up, not at the same level. That is the difference between decelerating and depreciating. Homes are not necessarily depreciating right now. The high rates coupled with economic uncertainty is keeping prospective buyers on the sidelines. Sellers are trying to introduce more concessions to entice them to sign contracts. Application volume, which gives us a sneak peek of buyer demand and how the housing market data will look in the following weeks, continues to cool. Purchase applications have declined in 8 of the last 9 weeks as demand continues to shrink due to the higher rates and economic outlook. Again, this is going to provide a lot of opportunity for home buyers that maybe earlier in the year could not get in because of the multiple offers, because of the over asking. All that has come to a screeching halt for the most part. The MBA also noted a drop in adjustable rate mortgages, which comprise just 8.5% of total applications. The average rate on an adjustable rate mortgage fell from 4.8 to 4.7%. Now, I know that a lot of people are still scared of an adjustable rate mortgage. I am not scared of an adjustable rate mortgage, and here's why. You just have to know how to use the product. There is nothing wrong with an adjustable rate. It is not a sign that you're desperate to get into a home. That's not what this is. You just have to be strategic about how you use this stuff. It's a tool. That's all it is. It's one tool. You don't have to get a fixed rate mortgage right now. But if you're going to do an adjustable rate mortgage, make sure you understand what happens if you ever get close to the point of that window where your time is about to end on that fixed part and it's going to adjust. You need to understand what's going to happen. Now, Back in 2006, 07, people were not informed. People just were jumping into these mortgages, which is part of the reason, obviously, we had a crash, right? We have such educated buyers right now. We have buyers with excellent credit, whereas back then, completely different. If you were breathing, you could get a mortgage loan in 2006 and 2007. You absolutely could get a mortgage with a pulse. Things are very different right now. So adjustable rate mortgages are a tool that, if used properly, there's nothing wrong with it. And it could be the difference between someone getting what they want and not, or qualifying or not qualifying. So get educated. There's nothing wrong with an adjustable rate mortgage if you use it correctly. Know what you're getting into and know how you are going to use it to get out. Now remember, even on an adjustable rate mortgage, if you want to do a refinance down the road, you do have to qualify. So if your financial situation changes for the worse, it might be an issue. So I want to put that out there because I don't like to just make these blanket statements like everybody can get an ARM and everybody can refinance in 3-4 years, right? Or 2 years, whenever the rates come back down. That's not the case. You do have to qualify. So I just want to put that out there again. Nothing wrong with an ARM if you know how to use it. So I want to get your feedback. Let me know, do you think adjustable rate mortgages are bad? Just put yes or no in the comments. Let me hear from you. So if you got any value out of this video, please hit that like button. Subscribe to the channel if you haven't already. Make sure you get notified every time we drop new videos. Join the Power Move community, guys. I want to hear from you. Give me some feedback. Let me know what's going on in your neck of the woods. And remember, don't just make a move, make a power move. I will see you on the next video. Go check it out over there.